March 1st is not just the beginning of a new month. It is the beginning of a capital cycle reset. Today, large funds are not reacting to headlines. They are recalibrating exposure. Risk models are updating volatility inputs. Commodity allocations are being adjusted. Hedge ratios are being recalculated. And billions in institutional capital are being redistributed quietly across asset classes. Gold is responding to that shift. Not with panic, not with explosive momentum, but with structural resilience. And that is far more important. When gold refuses to weaken in an uncertain macro environment, that is not random buying. That is defensive positioning entering the system. March opens with three dominant macro pressures. First, geopolitical instability remains embedded in pricing. There has been no clean resolution, no clear de-escalation. Markets do not need escalation to price risk. They only need uncertainty. Persistent uncertainty sustains safe haven allocation. Second, real yields are not expanding aggressively, they are stabilizing. Gold suffers when real yields surge sharply because the opportunity cost of holding non-yielding assets increases. But when yields stall or hesitate, that pressure eases. The absence of aggressive yield expansion is giving gold breathing room. Third, equity markets are stable but not euphoric. We are not seeing aggressive risk-on expansion. Momentum is selective. That tells you capital is cautious. When capital is cautious, gold becomes a portfolio stabilizer rather than a speculative trade. Now here is what makes March 1 different. Start-of-month flows matter. Large institutions often rebalance exposure at month open. If equity allocations drifted higher during the prior month, funds trim and redistribute. If volatility expectations increase, defensive assets receive incremental capital. Gold benefits from incremental capital. It does not need panic. It needs steady allocation. That steady allocation is visible in structure. Let's move into technical analysis. On the daily time frame, gold continues to respect a higher low formation. Each retracement has been absorbed above prior structural lows. That signals accumulation rather than distribution. Distribution would show lower highs and failure to defend demand zones. We are not seeing that. Instead, we are seeing compression. Compression is a critical signal. When price range narrows while holding structure, it suggests positioning ahead of expansion. Markets do not remain compressed indefinitely. They transition from compression to expansion phases. The direction of that expansion depends on which side of liquidity gets taken first. Now define the primary structural support. There is a demand region created by the last impulsive rally. That zone represents aggressive institutional buying. As long as daily closes remain above that region, bullish structure remains intact. If price wicks below but closes back above, that becomes a liquidity sweep. Liquidity sweeps are engineered to remove weak positions before expansion. If price closes decisively below with expanding volume, structure weakens significantly. This is your invalidation level. Professional trading is conditional, not predictive. Now examine intermarket signals. The US dollar remains critical. If the dollar strengthens and gold refuses to break lower, that signals underlying demand strength. If the dollar weakens even moderately, gold gains upside flexibility. Watch the behavior, not just the correlation. Next, monitor real yields. If yields rise sharply and gold holds structure, that divergence signals hidden accumulation. If yields fall and gold fails to rally, that signals exhaustion. Intermarket divergence often precedes directional shifts. Now consider volatility. Implied volatility in precious metals has compressed recently. Compression near structural highs often precedes breakouts. Compression near structural lows often precedes breakdowns. Currently, compression is occurring above higher lows. That statistically favors upside resolution unless macro shocks reverse positioning. Now let's shift into tactical execution. There are three primary March scenarios. Base case. Gold maintains higher lows and gradually expands toward prior highs. In this case, break above prior highs attracts momentum participation. Traders can look for breakout confirmation with volume expansion before scaling. Defensive case. Gold breaks support with conviction while real yields expand and the dollar strengthens aggressively. That invalidates the bullish structure. In this case, bias shifts neutral and traders wait for new base formation. Liquidity sweep case. Price dips below support intraday, triggers stops, then reclaims by close. That creates a spring setup. Such setups often lead to sharp upside reactions because liquidity has been cleared. In all cases, risk management must be precise. Compressed environments increase false break probability. Do not oversize positions before expansion confirms. Now let's discuss capital psychology. Institutional capital moves methodically. It scales into positions over time. That creates stair-step patterns rather than vertical spikes. If gold begins forming successive shallow pullbacks with controlled continuation, that suggests steady accumulation. If gold spikes and immediately rejects, that suggests emotional participation rather than structured allocation. Distinguish between the two. Now zoom out to monthly macro positioning. March often sets tone for Q1 performance adjustments. Funds that underperformed may seek defensive balance. Funds protecting gains may hedge exposure. That increases probability of baseline gold support. But remember, gold is not trading in isolation. Energy markets influence inflation expectations. Inflation expectations influence real yields. Real yields influence gold. If energy volatility increases, inflation expectations rise. If inflation expectations rise faster than nominal yields, real yields compress. That environment benefits gold. Monitor that chain reaction. Now let's refine technical levels further. Identify the most recent swing high. That is your upside liquidity magnet. Stops cluster above obvious highs. If price approaches that region, expect volatility expansion. Above that level, momentum entries trigger. Below structural support, downside liquidity pockets exist where previous consolidation occurred. If breakdown happens, those become targets. But until breakdown confirms, downside targets are theoretical. Trend bias follows structure. Now consider positioning risk. If too many traders anticipate upside breakout, the market may engineer a sweep lower first. That flush creates better entry conditions for institutions. Always be aware of positioning imbalance. Sentiment extremes often precede reversals. Right now, sentiment appears cautious rather than euphoric. That supports steady accumulation rather than blow-off top conditions. Now ask yourself, what would truly negate gold's constructive structure? A decisive geopolitical resolution reducing uncertainty. Aggressive real yield expansion driven by strong economic data. Sustained dollar strength breaking correlation patterns. Absent those factors, gold retains structural stability. But markets evolve daily. So do not anchor emotionally. Anchor to structure. As long as higher lows hold and compression resolves upward, bias remains cautiously constructive. If structure fractures, shift accordingly. Flexibility is strength. Now understand something critical. Gold does not need crisis to rise. It only needs persistent uncertainty combined with stable yields. That is the current environment. March begins with capital-seeking balance, not excitement. That favors measured accumulation over aggressive liquidation. Your advantage lies in preparation. Map levels. Define invalidation. Size appropriately. Wait for confirmation. Let volatility expand before committing aggressively. If you trade based on headlines, you will always be late. If you trade based on structure and flows, you position early. March 1st is signaling repositioning. Gold is not screaming. It is holding. And holding under uncertainty is strength. The market is leaving clues. Higher lows. Volatility compression. Stable demand zones. Intermarket divergence resilience. Those are not accidents. Those are footprints of capital. Your job is not to predict the future. Your job is to recognize when probabilities shift. Right now, probabilities favor structural stability unless proven otherwise. But proof matters. Let price confirm. Let structure guide you. Let invalidation protect you. That is professional trading. If you want deep macro logic combined with precise structural mapping, without hype, without noise, this is what Market Crux delivers. Subscribe if you want to understand where capital is moving before the headlines explain it. Because smart money never announces its shift. It leaves evidence. And those who study the evidence move first.